Okay, let's get started. We're now going to begin to talk about the part of the course that has to do with economic fluctuations, the ups and downs in the economy, the recessions, the recoveries, the booms, and the slumps. And then we're going to look at how we model these ups and downs in the economy. So first, we'll look at some of the facts, what's actually happening in the economy, and second, develop a model to explain those facts, and that model can be used for analyzing public policy. Let's focus on some recent ups and downs in the economy. On the lower left, you see real GDP growing over time, over the long haul, over several decades, you can see from the horizontal axis. And the ups and downs are illustrated by the blue line fluctuating to help you see those ups and downs. We've drawn in a red line. It's really potential GDP. It's a long-run growth path for the economy. We've been focusing a lot on what determines that long-run growth path: productivity, the amount of investment in the economy that adds to capital, et cetera. But now we want to consider the ups and downs and what causes those. The most recent up and down is blown up in the upper right-hand part of the screen. And you can see that entailed a recession where GDP fell. That's the 2007, 8, 9 recession. Began at the end of 2007 and in the middle of 2009. And then we've had a recovery. To some extent, it hasn't completely closed the gap between real GDP and potential GDP. Our best guess is that potential GDP has continued to grow, but we haven't really closed that gap at this point in time. So what we're concerned with now is really what causes that downturn in the economy as distinct from the long-term growth, and what causes the recovery, what causes the end of the recession where it begins to turn around, and what are the public policy roles in this part of the economy. If you want to see also what's happening with the ups and downs in the economy in the labor markets, this graph helps. So at the bottom, we've again shown you real GDP declining in the recession, beginning of 2007, fourth quarter towards the end. And then it's continued to the trough in this recession in 2009, and then the recovery. But in the upper part of the graph, there's a picture of the unemployment rate for the entire U.S. economy. And as you can see, the unemployment rate rises when you go into a recession and real GDP is below potential GDP. And then it starts to come down gradually as real GDP gets back towards potential GDP. So there's this general phenomenon that employment is relatively low when real GDP is above potential GDP, and unemployment is relatively high when real GDP is below potential GDP. So these ups and downs in the economy as measured by real GDP have huge implications for the labor market, the amount of unemployment in the economy. And you can see how large those swings are, going over 10% because of this recession, starting even below 5%. So what causes all this? That's what our task is in the next few lessons. This is an area which is very controversial, probably the most controversial part of economics. What causes those recessions? We're going to develop some model that helps explain that. Why do they end? A model that helps explain that as well. But the answers to those two questions really raise another question, and that is, what should the role of government be? Is it possible for government to mitigate these recessions, make them less severe? Does fiscal policy have a role for that? How much government spending there is, how much tax there is? Or does monetary policy have a role in that, the role of the central bank or the Fed? The debates amongst economists have been ongoing for literally decades. In the 1930s and 40s, you had a debate between Keynes and Hayek. In the 60s and 80s, until recently, a debate between Friedman and Samuelson. And those debates are continuing today with contemporary economists taking one side or the other. One side being that there's a particular kind of role for government, another having an argument that there's less of a role, or at least a different kind of role. So recognize that this is a part of economics which is controversial. It's probably one of the most important reasons to try to understand it, and therefore try to understand why the economists are disagreeing so much. What I would like to emphasize before we get on to building the models in detail is that there's a couple of important ideas that economists use for the most part to explain these fluctuations, the ideas behind the theory of economic fluctuations. So the first key idea is that these departures of real GDP from potential GDP, which you saw in the data in actuality, those departures are really what's going on in a recession or a boom. So on the left-hand side, we have a schematic illustrating potential GDP growing over time. And what we're going to argue that the downturn is really a departure from potential GDP. It's not potential GDP itself declining. We're assuming that's going to continue to grow. That's our best guess based on what we think drives potential GDP. That's long-run capital and technology. But so these departures are going to be what we think of as the recessions over on the left. And similarly, sometimes the economy is going to grow quite rapidly, kind of in a boom period, if you like, a lot of exuberance. And we're also going to think about the economy is growing even faster and above its potential. It's going to be possible to go on both sides of potential because potential is kind of an average, kind of a normal state of affairs. And sometimes you can be below average, sometimes you can be above average. And so that's the first key idea is when we think about the explanations for the ups and downs in the economy, they're going to be these departures of real GDP from potential GDP. The second key idea is that those departures are due to changes in the demand for goods and services. We're going to call it aggregate demand because it's demand for the entire economy. And it's important to think about this because one could say, well, it's changes in supply, but really supply has more to do with the potential GDP growth. So we're going to say that at some points in time, demand for consumption goes down or investment goes down. And when that demand goes down, firms produce less and they hire fewer workers. And that's what's going on in the downturns or the recessions. Similarly, at the upside, increase in demand, businesses get excited, they want to invest more. Maybe consumers get optimistic about the future, they consume more. And there could be policy variables related to both. And that's going to be a demand side factor. These ups and downs are largely due to demand. And that's an idea behind the theory of the fluctuations. Why does this occur? Well, think about the simple microeconomic model of supply and demand. This is a picture of a demand curve for a firm, individual firm's production on the horizontal axis, the firm's price on the horizontal axis, downward sloping line could just be a demand curve. The one in the middle could be sort of the normal demand curve for this firm. It could be selling bicycles, it could be selling carrots, could be whatever it happens to be doing, that's a demand curve. But then there's certain times where there's an increase in demand in the economy. And that could be represented in this firm by an increase in demand for bicycles, a shift over to the right. And you can see that's going to mean more production. The firm is going to supply more when that demand surge shifts. We kind of already know that from microeconomics. The firm will produce more when demand shifts. In the case of macroeconomics, in the short run, which is what we're looking at now, economists usually find that prices don't adjust that much. So it's kind of as if you're going over just in a horizontal direction in this diagram. You're moving over there without any increase in prices. If there was an increase in prices, you'd be moving over in this direction, so there'd be a smaller change in the quantity demanded, a smaller impact on total production for that reason. So these ideas that prices don't adjust rapidly accentuates the shifts in demand as illustrated in this picture. And similarly, going in the other direction, it could be a fall off in demand. Firms decide not to invest so much in new capital, and that's going to reduce the production by the firms who produce that capital. In this case, if the price falls, you'll get an attenuation of that. You'll get quite a larger decline in the quantity actually produced compared to what you get if the price was sticky or rigid. It didn't move that so much. And in macroeconomics for the economy as a whole, we see these rigidities as very important in the short run. Okay, so that's kind of the reason why we think of demand fluctuations in the economy as a driving force in the short run, not in the long run, of course, but in the short run. When you think about this concept, again, of demand, I think it's really important to question that and to really be sure. So you could say, well, what about fluctuations in GDP? Why couldn't it be that in a recession, say 2008, there was just a big decline in technology or productivity or capital available for production or the number of people who wanted to work? Well, of course, there are fluctuations in all of those, but they're usually kind of too smooth and not sharp enough to explain these very rapid, sharp declines in GDP during a recession. It's hard to imagine that suddenly people forget how to produce things. Their productivity declines rapidly in a recession just for no reason at all. And similarly, it's hard to imagine that people just decide not to work so much that unemployment rises from 5 to 10% in a recession. So it's probably related to things beyond just potential GDP changing. Now, rarely is there such huge declines in labor, capital, and technology at the time of a recession, and we've seen some examples of that. So the fact that that's rare, it's not impossible. You can imagine a very serious earthquake where production had to decline, but they're really rare, and they're rarely associated with recessions. So in some, they can have large effects. Sometimes the effects are more important during a recovery from a recession, because that's not quite as sharp as in the downturn. They're really slower moving. We've seen that in some of the pictures at the beginning of this lesson. The recovery from the 2009 trough is not so sharp as the decline into that trough, for example. So it's quite possible that these, if you like, supply side things are having more of an effect then compared to the recession itself. And one important example to point out is unemployment insurance. In a recession, when unemployment rises, people are laid off, and if they have unemployment insurance, they'll get some unemployment compensation during the period they're laid off until they find another job or are called back to work. Now, that unemployment compensation, in some sense, reduces the incentive to go get another job and look for another job. So it may have a tendency to raise unemployment compared to what it otherwise would be. It's a factor, that's the direction it goes. But certainly in a recession, that's going to be pretty small to the downturn that's occurring otherwise. It may be more noticeable in a recovery where everything is moving more slowly. But in general, they're not a big factor in these sharp ups and downs in the economy. We will focus on these demand side movements in the short run as distinct from the more supply side movements in the long run. And next time we're going to be considering a model that explains just this. Thank you.